Hello, everyone. This is an important update in August of 2025. Today, we're talking about a update to the earnings certain proxy, the Zacks earnings certain proxy, which is a core equity portfolio that I manage here at Zacks Investment Research. And this is just an update regarding the core philosophy, just reiterating the strategy, and why I believe that this remains the ultimate core equity portfolio strategy that investors should have. So let's take a look at the investment philosophy, methodology, and how the portfolio is constructed, as well as why I believe that this portfolio will return to outperformance versus the S&P 500. So overall, broad big picture, 10,000 foot view, the Zacks earnings certain proxy is a collection of 60 of the highest quality companies across the entire US large cap equity market. So what do we mean by that? These companies basically exhibit very durable business models, very durable. They are capable of withstanding recessions, bear markets, macroeconomic volatility, kind of like the environment that we're in right now. And this is why the companies that we have in the portfolio have had very little earnings estimate revisions. That's a big part, right, of the equity market. It's not only about growth, but it's also about revisions too. Revisions are also a big driver of returns. So while we have seen the average S&P 500 company get revised lower in terms of their earnings outlook for this year and next year, um, the portfolio of companies that we have in the Zacks ECP have barely had much in terms of negative revisions at all for this year and next year. And this is because these are companies that we have selected from the very beginning, over a decade ago, companies that have highly durable business models. They are companies that provide critical goods and services that are not discretionary purchases. They're not nice to haves. They're not luxury services. They are essential services that, both people and businesses depend on. Companies that have highly recurring revenue, either through long-term contracts or through subscription revenue, which have high retention and renewal rates. These are the types of companies, and I'll give you a couple examples of them a little bit later. But we have in our portfolio a collection of high quality companies, and by quality, we basically mean four broad principles. So the portfolio is optimized for four time-tested long-term value investing principles. Number one, EPS linearity, right? Linearity refers to, it's just a fancy word to tell you how durable a company's bottom line is over time. So we look for companies with very high earnings linearity, and you'll see an example of that visually. We look for companies that have the highest earnings linearity over a 15 to 20 year period. So we look for that long of a time frame in order to find companies that have demonstrated, that have proven durability over multiple macroeconomic environments that we've been through for the last 15 to 20 years. So earnings linearity is a very important and critical component to the strategy. So we look for companies with very high earnings linearity over long periods of time, say about at least 15 years, but preferably 20 years. Number two, obviously earnings growth. Everybody knows about that. So we do look for growth as well. But the reason why we don't just focus on growth is because growth is just one component among four that we have here. Whereas most investors just focus on growth, we look for growth within the context of high linearity, high returns on invested capital. This is very important, as we've talked about in many webinars in the past. Growth by itself is not the only thing that we should look at. We should look for efficient growth, companies that have growth with high returns on invested capital tend to outperform companies with the same growth but lower returns on invested capital, all else held equal. So return on invested capital tells you how efficiently a company is deploying capital in order to generate said growth. So very, very important. And number four, free cash flow conversion. Ultimately, the first three principles, right? Earnings linearity, earnings growth, and a return on invested capital. All three of those depend on earnings. And earnings, of course, is, the most important thing. But remember, earnings ultimately are a mixture of cash and accrual accounting. And so that's why, sometimes even if companies look good on earnings, if cash or cash flow is not confirming that earnings, then we run into trouble. This gets into, accounting irregularities, accounting shenanigans. Sometimes companies can report great earnings, but if they don't have the cash flow to back it, that could mean that there is some type of working capital shenanigans that they're engaging in order to generate, amazing growth, but that growth isn't actually being translated into cash flow. And so that is why we have the fourth principle there, free cash flow conversion. We have seen over long periods of time that some of the best companies on the planet, they generate free cash flow conversion above 80%. That's usually the target. That's not a highly enforced level. Sometimes companies can have 70% free cash flow and they're still very good. But we tend to really try to enforce the 50% threshold. We don't want to own companies that show, only 50% free cash flow conversion, meaning the ratio of free cash flow to net income should never really be below 50%. If that's the case, we would take a look at that and check out why that's the case. If it's because capital expenditures are very high, then we could, give it a pass. But for the most part, we look for companies that really rank above 80%. And that actually is the average of the portfolio, as we'll see in a future slide. The average free cash flow conversion of the Zacks earning certain proxy is roughly 84%, which, ranks it very high. And I continue to strongly believe this investment strategy should be at the core of every equity portfolio because they are long-term compounders, as we'll see in a couple of charts, upcoming here. These are companies that, are continuously reinvesting cash flows back into their businesses to grow, which means they compound capital over time. That means that they continuously create shareholder value, which makes them true buy and hold investments. Why? Because they continuously grow over time. And here is a visual representation of the portfolio. I would, draw your attention to the orange dotted line that you see here on the chart. This is the aggregate earnings per share growth of the portfolio over time. Of these 60 or 61 companies that we have in the portfolio right now, these companies have continuously compounded growth, in a linear fashion. And that's what we mean by earnings linearity, EPS linearity. So EPS linearity demonstrates business durability through various macroeconomic environments. If you just, can think about it, imagine all of the volatility we've been through these last 20 years. This chart goes back to 2005. Imagine, the great financial crisis of 2008, 2009. Imagine Brexit in 2015. That really rocked the currency markets. And actually, many indicators started rolling over here in the U.S. There was some fear of recession back in 2015, but you can see nothing. It didn't even impact it even a smidge for the earning certain portfolio. And even during COVID, you just saw a very brief, downturn followed by just a resumption of growth. So you can basically draw a straight line, and you can see that that's exactly how the companies in our portfolio compound over time. That's what I mean by when I say that these are true buy and hold investments because the companies continuously compound capital to generate consistent earnings growth over very long periods of time. And then you look at the second principle, EPS growth. So it's one thing to have EPS linearity, right? Because even utilities, for example, have EPS linearity, right? Utilities are very stable companies. So if you wanted linearity, if you wanted just stable growth, then you just buy utilities and call it a day. Well, if you did that, you would underperform the S&P by a mile, right? So we want both linearity and growth. We want, faster growth over time. And you can see that the earnings certain portfolio has indeed delivered that. So you get not only earnings linearity, right, which, we see here very small drawdowns of earnings. You can see that in the yellow dotted line, this represents the S&P's earnings. And so you can see that there's been significant volatility over these different periods of time. Here's that little dip that we got in early 2016. That was a result of the Brexit volatility that happened back then. That impacted industrial production and a couple of other macro indicators here in the US. And that impacted S&P earnings back then too. You can see that little decline, nothing for the earnings certain. And so you can see that over time, the compound growth rate has been significantly better than the S&P 500. And of course, way better than just utilities in turn. So we have, both linearity in terms of very little downside, and faster growth cumulatively over time. So this demonstrates superior shareholder value creation versus the S&P 500. And then we look at ROIC, the third principle, return on invested capital. Now, for years and years, you can see that our portfolio significantly outpaced the S&P 500 average, the market cap weighted average in terms of capital efficiency. So that means for every dollar of capital deployed, our companies generated roughly 14 cents of earnings over time in terms of the median over these last 20 years. Currently, that we're above the median at 17%. So that means that for every dollar that's invested, our companies generate 17 cents of profit, which is very, very good. However, the S&P in very recent years has really outpaced us. You can see that, that number is now 19%, almost 20%. So that has really shot up. However, if you look at it on an equal weighted basis, you can see that it is a very different story. So this is the Mag 7 impact, right? You can see that the difference here versus here is stark, right? On a market cap weighted basis, the S&P ROIC is almost 20%, so it's surpassed even the earnings certain portfolio. But on an equal weighted basis, the earnings certain is still significantly better. And so you can see that the only difference here is that the top 10 components of the S&P 500 are really swaying the results significantly. You can see that the difference there is, almost 900 basis points. Roughly 800 basis points from 11.7% to almost 20%. So again, this is actually just the skew that's resulting from the 7 to 10 biggest companies in the S&P 500. And keep in mind, the chart that we're showing you here for the earnings certain portfolio is on an equal weighted basis too. So we're, kind of comparing apples to oranges here. If we look at the market cap weighted average for the S&P versus the equal weighted average for the ECP. So if we compared it, truly apples to apples, then here you can see a significant difference in the return on invested capital efficiency of the ECP versus the S&P 500 equal weighted average. And here you can see the last, principle that we optimize the portfolio for, free cash flow conversion. We're at 87%. Actually, I mentioned 84% earlier, but I misspoke. It's actually 87%. That means for every dollar of net income, our companies in the ECP portfolio generate 87 cents of free cash flow. That compares to 74 cents for the S&P 500 equal weighted average. So again, we're superior on every metric across the four. And these are time-tested principles. These are not, um, principles that, should be ignored. Growth, ROIC, durability in the form of earnings linearity, free cash flow conversion. These are all factors that drive alpha in the long run. Um, and so why has it been that the S&P 500 has significantly beaten the ECP over these last several years? And I believe that the reason for that, the primary driver of our strategy underperforming since 2023 has been multiple expansion. On a pure earnings growth basis, Zacks ECP has significantly outpaced even the market cap weighted S&P 500. Here you can see a chart of earnings growth cumulatively over just these past 2.5 years, right? The ECP has underperformed the S&P significantly these last 3 years or so, or 2.5 years, really, 2023, 24, and so far through 2025. We're down, significantly versus the S&P. But if you look at earnings growth cumulatively over that period, um, the ECP has significantly, or not significantly, but comfortably outgrown the S&P 500, even if you use the in terms of the equal weighted portfolio. So that is over these last 3 years or so, since 2022, the S&P equal weighted portfolio has compounded earnings by 29%. That compares to 33% for the ECP portfolio. So we have better growth even over these last several years. So overall, in summary, the Zacks ECP continues to show pretty much all of these metrics. Superior earnings linearity, which shows business durability over time. Superior earnings growth over both 20-year and 3-year periods. Superior returns on invested capital versus the equal weighted S&P. Superior free cash flow conversion. Superior in terms of low beta of 0.03. And actually, I have a typo here. But the last, metric here should have been, the last, factor here should have been that despite all of the above, the ECP now trades at almost parity to the S&P 500 in terms of the forward, earnings multiple. The forward PE is almost equal to one another. And you can see that in the following chart here, but I'm just going to show you just a quick synopsis of the performance. Like I said, we have been underperforming surprisingly. This is a big, big deviation from how things were for the first decade, right? We incepted the portfolio in 2012, and we have never had a period of underperformance quite like what we're experiencing right now. You can see year to date, we're down versus the S&P. We're up 3.85%. The S&P is up 6.2. Last year, we were up 10 and a quarter. The S&P was up a blazing 20, almost 25%. The year before that, we were up 11.6. S&P was up 26%. Now, keep in mind, the ECP portfolio is pretty much doing what it always does. We've always kind of been in that range of, say, 8 to 12% returns per year consistently. That's been the case since inception. Here you can see since inception, our annualized return has been 12.3%. That's been, the typical year for us going back to 2020, 2012, I should say. Whereas the S&P has really deviated from its long-term average, and it's really picked up. Again, like I said, primarily because of the top 10 components basically dominating roughly 30 to 40% of the index. That is an extreme move. It's an extreme deviation from the long-term average. And if you look at it over the last several years, just the last couple of years, the S&P 500's gains have come primarily from the top 10 components, and that too primarily from multiple expansion. And so even though we've backed off the recession thesis, if you recall, and following my webinars from over the past 2 years, almost 2.5 years now, for 2 years, I've been, calling a recession, and I was wrong about that. I made a whole video about, why I was wrong. Um, and I backed off of that approximately 9 months ago, towards late 2024. I backed off of that recession thesis for multiple reasons. I have a video about why I did that. Um, you can look at it on our YouTube channel, on the Zacks Pro YouTube channel. But 9 months ago, I backed off of that recession thesis. But despite that, right, even though the recession is not my base case anymore, the index is now well above 23 on a forward PE basis. Relative to the 10-year bond yield, this is a bottom decile equity risk premium over the past 50 years. This means that we are very expensive relative to where bond yields are right now. Historically speaking, forward-looking returns have been muted when we get this expensive relative to the 10-year treasury yield. So we don't think that this is sustainable in the long run. These types of double-digit returns in the 20s, we just don't think is sustainable in the long run because we're already at very elevated forward PE multiples as it is right now. And here you can see a chart that essentially shows this. This is looking at the forward PE multiple of the S&P 500, right, market weighted average, relative to the earnings certain portfolio. And here you can see that in the beginning of 2023, the S&P traded at a discount to the ECP by about 27%. Here you can see the ratio of the chart. If you look at all the way to the left hand of the chart, the ratio is somewhere around 0.74. So what this is showing you is the PE of the S&P 500 divided by the PE of the Zacks earnings certain proxy. And that number was at 0.74 at the start of 2023. And that number has rocketed to now 0.92. So there has been a significant gain in the relative PE multiple over these last 2.5 years. That is essentially the source of the underperformance that we have seen. Because remember, we're not underperforming the market because we are compounding earnings slower than the market. We saw that chart in the past over here. We saw that chart over here, right? We are actually outpacing the S&P 500 earnings growth over these last 2.5 years. But the S&P has gotten a much bigger benefit, a much bigger boost because of its multiple, right? And that's because of, as we know, we watch the news every single day, and every single day the talk is about significant gains from companies like Microsoft, Oracle, Nvidia, Amazon, Google, these companies and the hyperscalers, significant spend on AI, significant excitement surrounding AI, especially with Meta and others. Many of these companies we don't own in the S&P in the ECP portfolio. We do own Oracle and Microsoft, but remember we don't have them at the weights that the S&P market weighted average has them. Remember, just 10 companies explains roughly 35%, I believe, of the S&P market cap weighted index now. We are nowhere close to having those types of weights into just 5 or 10 companies in the ECP portfolio. So, again, a big source of the outperformance of the S&P 500 relative to the earnings certain portfolio these last 2.5 years has been extreme multiple expansion. That's what's driving the majority of the index outperformance versus the ECP. And eventually, here's the main takeaway here. Eventually, the source of the index's returns will rotate from multiple expansion to earnings growth. This is a certainty. This is an economic law. You cannot have perpetual multiple expansion. You just can't, because ultimately, eventually, you're borrowing so much from future growth that returns will eventually rotate away from equities towards a risk-free asset like treasuries. That's what, just valuation, principles of valuation tells us. You cannot have perpetual multiple expansion. It's just not possible. So eventually, um, the index's returns is going to have to come from earnings growth, and it's going to rotate away from multiple expansion. When that happens, I believe that that's already started to happen. Because remember, now so far this year, the S&P's returns through 8 months now, or through 6 months, through halfway through the year, is only of about 6%. If you go back to this chart right here, right, we're only at 6.2%. That roughly is in line with the S&P's earnings growth. And again, on a market cap weighted basis too, the S&P's earnings growth has been, roughly in that ballpark of 7.5%. So I believe that that process has started now, where the index's returns is no longer coming from multiple expansion and is now coming from fundamental earnings growth. That's what is actually, in the long run, what explains the vast majority of the index's returns. In the short run, multiple expansion or contraction can explain a majority of the index's returns, but in the super long run, over decades of time, the index's returns ultimately is explained by earnings growth. And so I believe that that will eventually return, and I believe that that process has started now. So when that occurs, we believe that the Zacks ECP will return to outperformance. So again, I believe to stay the course, own recession resistant, durable, moat protected, low volatility, steady compounders. These are some of the highest quality companies in the entire equity market. And I believe that this is the place to be even now, but especially now. Now that, the market is hitting, multiples that we haven't seen in many decades now, in 2 decades plus relative to the 10-year bond yield. Valuation is not going to be the market's friend now. It was a tailwind. Now I believe it's going to become a headwind, and I believe that process has already started now. So I believe now, if ever, is the time to be owning the ECP portfolio, and these are some of the companies that we own. Very durable, very, very consistent compounders over time. And here you can see, just visually speaking, how steady these companies are. They compound continuously over time, very, very steady growth, very predictable earnings growth, because these are companies that don't make nice to haves. They make essential services and goods. And that's why the portfolio is built for long-term durability, as we see here. In the aggregate, across all 60 companies in the portfolio, this is what the earnings growth looks like. This is what the earnings stream looks like. Consistent, and durable over very long periods of time. So I hope this helps. I'd love to hear from you on this investment strategy. I'd love to hear your opinions and thoughts. If you have any questions, please do reach out to us. You can reach us at 1-866-794-6065 or send us an email to strategycall@zackspro.com. Thanks everyone, and talk to you soon. Bye.